Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focusing on clients who recognize the need for solid investment advice, who don't want to invest on their own, but still want to be educated through the process. This is the Tuesday, May 27, 2025 edition. Let's get started. All right, we'll start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. Stocks will go up and down on a daily basis for a variety of reasons. So our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. The prior 2 weeks, we had a gain of about 2.5%, bringing our year-to-date decline to about 1.3%. We had risen to a positive year-to-date gain, but this past week we saw a decline that brought us back a little bit below where we started the year. Next, we'll look at interest rates as measured by bonds issued through the U.S. Treasury Department. Interest rates, we believe, are factored into every investment calculation and are the preeminent measure of investment risk. Generally speaking, lower rates will lead to higher stock prices and higher rates will lead to lower stock prices. Rates, again, will move up and down on a daily basis for a variety of reasons. So our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. This chart, we have interest rates listed over here on the left-hand side and maturity lengths over here on the bottom from 1 month, 3 month, all the way up to 30 years. And each of these corresponding dots represents an interest rate for a given maturity length. Green line is where we ended the week, the 2-week period, and the brown line is where we were 2 weeks ago. So again, no real change on the short-term end of the interest rate curve, and we did see some increase here in the medium and long-term rates, which we'll get into in a little bit. All right, so we're going to add what we call recent developments. So instead of spending a lot of time talking about the stock market and interest rates and then trying to weave everything into our expectations and implications portion, we want to break this out so we can try to focus on the things that we felt were the most important events over the last 2 weeks and then kind of lead that into where we think we're going from here. We've used this chart a couple of times recently after we came out of the tariff tantrum and we had the initial 90-day delay. We figured we would trade within this range, a 5% range of the 5,500 level. And that looked pretty good up until we got out of the negotiations. The US and China 2 weeks ago had some negotiations over the weekend, and the information that came out of that was much more positive than we thought. So the market ended up pushing significantly higher. Pretty much the entire gain that we had for the last 2 weeks all came after that initial meeting and the news that came out of that. The market did push a little bit higher. We will get into why we think the market came down a little bit, but what we're hoping is that this red line at 57.75 will actually now act as a floor, right? Because this is the peak that we got to when we initially had tariffs on Canada and Mexico that drove the market down about 10%. We recovered when he gave a 30-day delay, and we're hoping that this becomes a level that stocks will, maybe they'll get back down to that level this week or next, but then it'll be able to continue higher. That's kind of what we're hopeful for. We did see pharmaceutical companies take a hit to their stock prices. President Trump signed an executive order trying to get them to have U.S. citizens pay less for drugs because they're charging significantly more for us to pay for drugs than they are for people in other countries. And so he wants there to be a balance. He wants them to charge more money to those citizens of other countries. So we'll see how that goes. We did see United Health take a hit. They're a very large portion of the healthcare sector, and there's a criminal investigation into how they're conducting their business. So that helped lead the market a little bit lower. Let's see. President Trump also took a tour through the Middle East and announced a lot of significant investments in those countries as well as with those countries. And there's a lot of distractions or controversies that the media focused on, but we're still optimistic about what it can mean for the U.S. companies and the stock market in general. As far as economic information, this is our CPI, the Consumer Price Index, this is the inflation level, which again, we had significantly high inflation back in 2022. It came in surprisingly lower than expected, and we're getting a lot closer to that 2% level that the Federal Reserve says they want inflation to be in order to maintain price stability. So that was a positive feature. The producer price index also came in lower than expected, and we get another inflation reading called the personal consumption expenditures, and that comes out this week. And everyone's forecasting it to be lower based on what we've seen here from the other inflation readings. Retail sales came in positive for the month of April. We had a lot of front running of the tariffs in March, and so we had a very significantly high reading for the month of March. But we still had a positive reading for April, which suggests there's still confidence in the market. We look at initial jobless claims and continuing claims, right? There is some seasonality to jobless claims, right? Obviously, end of the year, beginning of every year, we see some seasonality, people taking temporary jobs for holiday seasons and during the summer months, teachers and others are taking some time off and are counted as unemployed. So there's some seasonality to it, but so we expect the absolute numbers may increase here over the next couple of months, but not seeing anything that's concerning, and the initial jobless claims are lower than we anticipated. As far as continuing claims, right, we have some distortion of the data based on the COVID pandemic, driving that up to 25 million continuing claims, but relatively stable on continuing claims. Obviously, it looks like it's going up at a upward trajectory from where we were back in 2022, and that's kind of what we're one of the things that we're watching because we're in an environment where back in the pandemic people were let go, and when they tried to bring them back, people didn't want to come back to work, and so they had to pay more money for these people to come back to work. And we had an imbalance of how many job openings versus how many people looking for jobs. It was pretty much a 2 to 1, two openings for every person looking for a job, and that's come back into balance where we've got one job opening for one person looking for work. And we're at a point now where we think um, they may let people go, or they may try to have them stay on but take a pay cut. And we just think that it's going to be much more difficult for people to try and leave their job for another job, or they're not going to get paid as much, right? There's no incentive for them to leave if they're not going to get paid as much as what they're getting paid for what they're doing now. But at some point, companies will recognize all that as well, and they're either going to let them go or they're going to have them take a pay cut. And the continuing claims could end up continuing to rise as people struggle to find work if they get let go, and that would also lead to a higher unemployment rate. So that's something that we're going to be keeping our eyes on. The real estate market tends to be a little bit of a mixed bag. We're seeing lower building permits filed in April. Housing starts were higher. New home sales were higher than expected and are at the highest level that we've seen since 2022 when interest rates were going up. But this is existing home sales, which back during the pandemic, we were at about a 6.5 million homes per year rate, and now we're down at 4 million per year, which is the lowest April reading since 2009. So if you're trying to sell a home, it's probably a bit of a struggle. Um, but anyway, interest rates, or how much that people are trying to ask for their homes, the endowment bias that people have tends to be causing some issues there. But we think one of the biggest stories of the past 2 weeks was this credit downgrade. So we've got three credit rating agencies. We've got S&P, Moody's, and Fitch. And what their job is to do with governments or companies or whoever is trying to issue debt. They look at financial statements, they look at cash flows, and they try to make a determination if there is a probability of default, and then what is the loss, assuming they do default. And based on all their calculations, they will give a credit score to those companies or those government entities that are issuing debt. And as long as I've been around, and even longer than that, the United States government, the Treasury, has been what we consider risk-free. Um, we can print money. So if we need to borrow money, we can always pay people back plus interest. But what we don't know is how much money that will be worth, because if we have to keep printing money, inflation will keep going up, right? So the value of that dollar that we're getting back may be lower. Um, we had we have a very large national debt. You can see we're in the trillions, right? 20, 30 trillion dollars of marketable US debt. You can see we had a shift in the trajectory of debt back here in 2008, 2009, and throughout the 2010s. And then again, we've had another shift in that trajectory since the COVID pandemic. We believe that that's unsustainable. We believe Congress really needs to get their act together and balance a budget, or better yet, have a surplus so we can reduce this debt. Um, but that is not necessarily what we're seeing. But we think that's one reason why President Trump is trying other sources of revenue like tariffs to try and raise money without an explicit increase to a U.S. tax income tax rate that we would be paying on our wages. But we think that it's interesting because S&P was the first one. After coming out of this financial recession, they downgraded the U.S. debt from the AAA rating to whatever the next half step down is. Fitch downgraded us here in 2023 following the COVID pandemic, and now S&P, or sorry, Moody's is the last to downgrade. Um, what's interesting is this is how much interest we are paying on that debt. We are almost at $1 trillion per year just paying interest, right? Not collecting taxes for anything to benefit the American people, $1 trillion of tax revenue to pay interest on the debt. So again, we think it's unsustainable. We really need action. We're hoping that, a mix of spending cuts helped with the Department of Government Efficiency and Congress actually coming to the table and having some kind of an agreement that we can have a budget that works, that we can start paying down this debt would be fantastic. But we're also kind of realistic and seeing that what's been going on for decades and not incredibly optimistic. So hopefully this gets taken care of. But if now we've got credit rating agencies saying, look, your debt is unsustainable, the amount of interest is unsustainable, without seeing some of these changes in Congress or to tax rates or whatever, then we can't, in good faith, call you AAA rated. So um, we ended the 2 week period. So that leads me to there was a Treasury auction on 20-year U.S. Treasuries, and if we go back to it was right here on Wednesday. This is this is when the auction happened. So because of the downgrade, investors were demanding a higher interest rate for that Treasury debt. And again, when we talk about higher interest rates lead to lower stock prices, like this was the immediate impact of that higher interest rate that investors were demanding because the US was no longer a AAA rated uh, debt issuer. So very interesting. We're hopeful that it's not going to have a long-lasting impact. But again, we need to get our fiscal house in order if we want to get back to AAA status and ultimately have the stock markets have a long-term um, positive impact. We ended the 2 week period with President Trump threatening higher tariffs on Apple if they don't make iPhones here in the US. Also, higher tariffs on the European Union because trade negotiations have not been going as well as he would like. They made an initial announcement, but as far as details, we're not getting a lot of details. So I heard one economist say that the tariffs are not an on-off switch. The tariffs are like a dial, right? We're going to have tariffs at this point. It's now just, are we turning them up or are we turning them down? And we turned them down on the European Union after we had this announcement, but now Trump is turning them back up. Although this morning he has delayed that tariff from June 1st to July 9th. So we're all kind of coalescing around this beginning of July, maybe Independence Day kind of an announcement. Um, we'll just have to wait and see on that. But I think that's all for recent developments. Again, a lot's going on, and that's kind of the way it's been for the last few months. But as long as we feel like this is going to be worth taking some extra time to talk about, we'll do it. All right, for the investment implications and expectations portion, again, we still think that the stock market's going to trade in a trading range. It just might be at a higher level than what we thought a couple weeks ago. We still think that volatility is going to be a little bit higher and stocks are going to be relatively flat. Interest rates will be relatively flat until we get closer to that 90-day or the end of the 90-day delay in early July. We've got Congress working on the one big beautiful budget bill. The House has passed it. The Senate will take a look at it. Hopefully, it will become a little bit more in balance by the time it gets passed, but we will have to wait and see. And we think that whatever the deficit is that comes out of that bill is what Trump's waiting for so that he knows what the tariff rates should be for all the various trading partners. And once he's got that number, and so he can make up the difference, then he'll make those final announcements. And again, hopefully we'll just get the clarity we need so that the market can say, okay, this is where we are. Now we can move forward and get back to business as usual. NVIDIA is a large component of the stock market. They report first quarter earnings this week. Everything that we've seen so far has been pretty positive, so we expect them to have a positive outlook on their future revenue and earnings, which we hope translates to higher stock prices for the market. The Federal Reserve board members are not expressing any intent on cutting interest rates anytime soon. They're expressing patience with economic data, so we don't have any reason to believe that they're going to make a cut at the next meeting. But what we are hoping or thinking that is going to happen if we do end up trading in more of a range for the next couple of months, we may be doing a little bit more trading in the activity or in your accounts. So you may see more trading activity in your accounts over the next couple of months as we try to take advantage of a little bit more of a tactical position. So the investments will stay the same. We'll just be rebalancing maybe a little bit more often. All right, as a final word, we've been paying a little bit of attention to the NBA playoffs this year, mostly just watching highlights of games, not full games themselves. But it seems like there are a higher number of games this year where one team is down significantly to the other by a margin of like 20 points, and they're somehow able to overcome that deficit and win the game. We've seen games that statistically should be won because of the margin and the number of seconds remaining in the game. But we've been surprised to see that that hasn't always been the case. Miracles have been happening, I guess is what we could say. So two of those teams are the Indiana Pacers and the New York Knicks. They're actually playing each other right now in the Eastern Conference Finals, and it's been pretty wild. But what we try to do with investing is not find ourselves in that position, right? If we are able to invest in a way that we can limit those deficits or limit the downside, then it makes it a lot easier for us to recover and post positive results. And so, in the world of finance, we call that diversification, where we're trying to invest in a couple of different areas, knowing that we may not hit it out of the park and have fantastic returns in a short period of time, like some people allegedly do. But what we're trying to do is make sure that we're delivering consistent returns and making sure that if we do have those unexpected deficits, that we can recover from those. So we've been in the process of sending out performance reports. We think that all things considered, we're doing pretty well. And if you got questions, please let us know. But again, we appreciate your time, and we're always here to help as much as we can, and definitely answer questions if you've got them. So we hope you guys have a good rest of the week, and we'll see you soon.